The EVOFEM Biosciences stock has been a very popular stock recently, and in this video, we're going to look at its price actions, the recent developments, the technicals, and my opinion on if you should buy the stock. As the market is very volatile at the moment, we should always be careful about which positions we choose, as well as their individual timings and exposures. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. EVOFEM has had an amazing run over the past week or so, and many are expecting the stock to continue its upward trend in the upcoming week. From a fundamental perspective, I think that we should expect some retracements from the previous uptrend momentum, which is a normal behavior of market participants, especially the retail traders who tend to be more eager to realize quick gains for their capital. What this does is that a portion of the open positions would be filled with less buying orders to sustain the bullish run. From a price action perspective though, I have a tendency to look at the whole picture as the beginning of something that is more significant than the current uptick. It feels like what happened with Bionanogenomics back then, arguably within a more challenging environment. The main challenge for the stock is whether it can bridge the gap between the immediate and the medium term, as other good news are expected to come later this year or maybe the next as well. The mentality is also going to play a significant role in this because the stock is considered to be a small cap, so I wouldn't worry too much about the short-term volatilities and even sell-offs, but if the position takes a large portion of the capital in our portfolio, then it's possible that a waiting game could be more challenging. Now, let's also take a look at its technicals. The trading volume of EVOFEM has recently been around 51 million shares versus the average volume of 80 million shares. Over the previous 52-week period, its price fluctuated between 28 cents and $15.60. The trading volume is a metric that can tell you how many shares have been exchanging hands and whether there's a lot of activities and attention on the stock. It often gives you a first idea about the popularity of the company. When we use it to compare the average volume, it can also tell us if the company is enjoying additional momentum to reverse the trend or to break through the current resistance levels. Even when the current volume is lower than the average, it is an interesting indication because it may signify that a trend reversal could happen soon. The market cap of EVOFEM is currently around $48 million versus an enterprise value of $174 million. To put simply, the market cap is the fair market value the company has based on the current market sentiment, the company's reputation, and other macroeconomic factors, whereas the enterprise value is usually the cost the company has already paid for its assets after paying off the debts. It's worth mentioning that one of the most significant assets for many of those growth-type companies are the intangibles, meaning they're not things that you can see or feel, but rather promises that a company can grow significantly in the future. For startups, most of their valuations are based on the intangibles, and if they were valued in more favorable market conditions, what this means in concrete terms is that there could be a huge difference between the market cap and the enterprise value, giving a false impression to the market participants that a company is trading at a discount. It's only trading below the book value, but that doesn't mean that a company itself is necessarily undervalued. It's also possible that a company itself was overvalued in the first place and it has only deflated back to where it's supposed to be ever since. As we compare the current price to the historical price fluctuations, the stock is 378% higher than the 1-month low, 378% higher than the 12-week low, and 378% higher than the 52-week low. On the options market, which often gives a hint on the market sentiment about where the stock price is likely going to go next, the implied volatility is 253% versus a historical volatility of 330%. The put-call volume ratio is currently just around 0.03. It is normal for most stocks to also tend to have a higher put option volume than what they deserve, because institutional investors hedge their long positions by buying put options to cover them. Now, what this means is that EVOFEM has very little demand for put, meaning most people trading the stock expect the title to go higher. The most recent volume of options traded has been 13,000 contracts within a day, compared to the 30-day average volume of 15,000. In terms of open interest, the most recent volume of open interest has been 191,000 contracts versus the 30-day average of 103,000 contracts. The option contract is a derivative from the underlying security, giving participants the possibility to have a right to either buy or sell the security at a predetermined strike price, buying the contract giving you the right, and selling the contract giving you the premiums, with the obligation to exercise the contract if the counterparty chooses to do so. It is often said that you can evaluate the likelihood of a scenario based on the opposite of what the current ratio is. If there's a lot of put options, there could be an uptrend on the move, or that a reversal may happen if there's a lot of call options. The reasoning is very simple. Most people trading options try to catch a gravy train once it's already gone, and as a consequence, most option contracts would expire worthless. In terms of the shareholder structure, institutional shareholders own about 155% of the outstanding shares. The biggest shareholders are Mirador Capital, Vanguard, and Fidelity. It is relevant to understand the shareholder composition of a company because it helps to determine whether you should hold the stock long-term or to view it as a trade opportunity. If the stock is mainly held by retail traders, this may be a sign that the stock lacks the depth to justify long-term trust from shareholders. Typically, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. This is obviously subject to a lot of exceptions, as many great companies are also mostly held by retail investors, but that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes when there is significant short interest in the total volume, that may be a sign that there's an organized shorting operation going on, such as what happened with GameStop and AMC. The current short interest is around 17% of the total float and 51% of the transactions coming out of the dark pools. Usually, if the short interest is above 15% of the total volume and a significant portion of the short volume coming out of the dark pools, this could suggest there are institutional positions taken to short the stock, and that there would be potentials for a short squeeze. Of course, with where EVOFEM is, I would say that the 17% has some of it that is due to the fact that, the stock is increasing significantly in the stock price, not necessarily because institutions are taking a position to short the stock in massive scale. So my recommendation is to build up a position in EVOFEM gradually over the next 6 months, and to cash out when the profit reaches around 30 to 50%. And for those who want to remain in the position for the long term, I would recommend to do so with the gains only, so that psychologically we can resist the short-term temptations. I would recommend to commit between 1 to 3% of your portfolio in EVOFEM, and would also recommend to split the allocation in batches of 20% at a time so that you may purchase more if it retraces. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally, that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.